Hello everyone, welcome back. I got some really good ones for you today on this Thursday, March 23rd, 2023. Lots been going on inside the markets, economy, geopolitics lately, so let's dive right into it, shall we? Markets. The three major US stock indices all, put on modest gains today. At one point this morning, I saw the 10-year yield at 3.48%, so down below 3.5%. When those yields fall, especially below 3.5% in this environment, it kind of stokes inflation and risk assets. It's kind of like you have that yields and rates falling narrative that kind of underpins rising risk asset prices. So you've seen a little bit of that, little bit of dollar weakness. Good sign for things like the NASDAQ, oil, Bitcoin, and gold. Oil, doing quite well since Buffett's purchase during the banking fiasco last week. Buffett sank $350 million into oil stocks, so that's something that you should be monitoring as I think energy continues to offer some pretty good opportunities. So looking at large cap oil, you can also look at uranium. Cameco, stock ticker CCJ, one of the largest uranium producers, pretty stable jurisdiction. Not a buy or sell recommendation, but liking what I'm seeing going on in energy. Gold doing its thing. I love gold. We talk a lot about physical gold on this channel. I recommend my video, Gold and Silver. Did it about 6-8 months ago. Took you as far down, pretty far down the gold and silver rabbit hole. Gold's doing well, but I want to caution you against running out and spending these premiums for physical, because generally, once a banking crisis is hit and gold has already hit all-time highs, it's just kind of, I feel like, luring people in. But physical gold's generally stable, all right? So even if you were to, buy some at 1900 and it pulls back to 1700, it's still an ounce of gold, okay? It's not like you're really... Put it this way, if you buy gold and it goes up and you sell it, you're booking illusory profits in this rigged game. Gold just goes up because the dollar's going down and vice versa. So be careful with getting all neurotic and fearful and running out and selling everything and just buying some physical coins and sitting on a ton of cash. Just my opinion, do what you want, but I'm not really in that camp, and I think it's kind of the wrong time to be doing that. In the last few videos over the last few months or so, whenever I've talked about gold, I've said things like it's doing that thing where it's creeping back up while no one's watching. That's really the time to be buying gold, when it's not drawing lots of interest. When we use the terminology like drawing interest, don't think in finance terms, think in terms of psychology, like drawing interest. If you buy an asset and it begins to draw a lot of interest and go up in price, you generally want to be selling to those people while it's drawing a lot of interest and not just following the herd. But the banking contagion, clearly spread to other parts of the economy. We saw UBS step in and buy Credit Suisse, distressed capital with probably, what did Credit Suisse have on its balance sheet? Some 10 billion that UBS was able to buy for 3 billion, essentially. UBS was able to buy a Credit Suisse at a fire sale price. A lot of people are using Credit Suisse to, help push along the narrative that the banking collapse is here, but Credit Suisse has been a $5 penny stock since I was in high school. It's really been irrelevant since 2008, along with Deutsche Bank. Some of those banks are numbers 68, 85 on the leaderboard. They really don't have the effect in the real market that you'd think, given their branding and their recognition. So, I think UBS buying Credit Suisse wasn't as big of a deal as people made it out to be, but it does highlight a trend we are going to continue to see going forward, and that's larger banks buying up the little guy and consolidating the banking sector. So, I want to say I'm bullish on financials right now, but just be very picky and choosy on which ones you go with. But, if I were given the choice between run out and buy a bunch of gold coins right now at coin shops, or look at some of these regional banks and financials that have been beaten down pretty good, I would actually be looking at the beaten down financials, especially because if you're a savvy physical gold buyer, not investment, remember, because this isn't investing, there's no counterparty risk. But if you're a savvy gold buyer, you buy gold when no one's looking and you have stability in the banking sector and the price is a lot lower. You don't just chase gold every time it's, getting its shine back or whatever, clever, adjectives the mainstream media wants to use whenever gold's, regaining its luster. You don't want to buy it when those are the headlines. And then on the flip side of that, you have these regional banks that, a lot are going to get bought by the bigger guy for pennies, but a lot are going to be crushing it in about 5 years from now. And right now, they could be trading, 90% off their recent highs right now, for all intents and purposes, a crash. So, do what you want. This is, I'm not doing buy or sell recommendations on this channel, but, the premium is buried in those asymmetrical opportunities where market expectations are one thing and then reality is completely different. Put this another way, you should be contrarian. But when it comes to investing, you need to be contrarian and right. And that's very difficult to do. Anyone can be contrarian, okay? You just say the opposite, and just, be contrarian out of principle. Look, that'll get you killed and eat your lunch. I truly do believe that. But if, lived it. But if you're contrarian and right, that's really where the premiums are buried. So I think there could be some good opportunities in some of these beaten down financials. But if you wanted to, if you wanted to play the financials safer, then stay closer to the beast system. So the big four, JP Morgan, Bank of America, Wells Fargo and Citi. I don't like Wells Fargo and Citi, but they are, part of the big four. They have trillions of dollars in deposits. They have direct line-ins to the Federal Reserve. They love buying distressed capital in these smaller regional banks, but also with insurances from the government and hedges in place. So, stay close to the beast system: BlackRock, Vanguard, Bank of America, Goldman Sachs, JP Morgan. And I think those financials will really clean up. And then these littler guys that run around in these more niche circles like Silicon Valley Bank and Signature Bank, they get targeted by the big guy and they're not offered the same protection. So just be careful as you proceed. But, and I guess this is a good opportunity to give you my perspective on who they are, they. It's kind of complex. You always hear, the Fed tells the banking system how it's going to be. No, the commercial banks ultimately tell the Fed how it's going to be. And you never really know if the dog is wagging the tail or the tail's wagging the dog or what's going on. Handing around that responsibility, passing that responsibility around, helps actually to abdicate themselves, and remain in power. When people think oftentimes they go right to the politicians. But the politicians, they exist much further down the Ponzi. They're nowhere close to the capstone, the top of the pyramid, I don't look at the United States as much as a country as I do a corporation, in a very large pyramid. And the people at the top of the pyramid, they're much higher than the politicians. And this is the unelected totalitarian uniparty, like the Janet Yellens, the Jerome Powells, the Ben Bernanke's, Jamie Dimon, the CEO of the largest commercial bank, Larry Fink, who owns the CEO of BlackRock, who is the majority shareholder of JP Morgan, of Wells Fargo, of Citi, of Bank of America. That's owned by BlackRock and Vanguard. And you might be saying, okay, but isn't the Fed like a government organization, or is it a private bank with private shareholders? And it gets kind of tricky, but I can help you kind of cut through that. The Fed does have shareholders, okay? They're not structured in the same way as, your typical stock, but there are member banks to the Federal Reserve System. You can look this up. There are the top 10 member banks being JP Morgan, Wells Fargo, Bank of America, PNC Financial, Capital One. You know, there's about like 10 of them that are the largest member banks of the Federal Reserve System, and they're collecting dividends from the Federal Reserve System. So, you know, Jerome Powell the chairman of the Federal Reserve, he does have arguably more power than the president of the United States, but he was trained under Janet Yellen, the Treasury Secretary. You know, he was her protege. And she used to be the chairman of the Federal Reserve. So you can see how she went from chairman of the Federal Reserve, or chairwoman, and became the Secretary of Treasury. And then the dude, Jerome Powell, she trained, takes over at the Fed. And then when they have issues or a problem or want to discuss things, they call the CEOs of their member banks. But the CEOs of those member banks, you know, like JP Morgan, PNC, Capital One, the majority shareholder of them is Larry Fink at BlackRock and Vanguard, the CEO of Vanguard, who was Jack Bogle, but I don't know who's running it now. Jack Bogle died in 2019, but, you know, Jack Bogle is a good example of who they are, you know, a bit of a Rockefeller of our generation. So, yeah, it's the Fed, but the Fed kind of is owned by the 10 member banks. But the 10 member banks are owned by BlackRock and Vanguard, but they all kind of have a crucial role to play in this game. So they, to me, is the Secretary of Treasury and then her little clique. So Janet Yellen and her team, the Federal Reserve System, so Jerome Powell and his team, the CEOs of the 10 member banks of the Federal Reserve and their teams, and then the people who own them, which is ultimately BlackRock and Vanguard, and then their team. So Larry Fink of BlackRock, the CEO of Vanguard, Jerome Powell, Janet Yellen, Jamie Dimon, that's kind of who they are. And then I'm sure they're taking advice from some like wise oracle or something. So, you know, there's going to be people that are kind of like hidden in the shadows. But also that's by design. Like Larry Fink, who has 12 trillion in assets under management, he doesn't want everyone to know that. You might not even know what BlackRock is, but I guarantee they're the majority shareholder of all your favorite companies. You know, and that was just started by like a few dudes that were doing private equity in the 80s, and then they beat the game, broke the game, and now make the markets for the game. So essentially BlackRock and Vanguard, you know, they don't play in this rigged casino like we do. They own the rigged casino we play in, and all these banks kind of play in. And you might be like, where's Goldman Sachs and all this? And they're not a commercial bank, but they are a very, very large investment bank. So I would qualify Goldman Sachs as kind of they as well. Immense power, immense deposits, perhaps too big to fail. So your too big to fails would be like JP Morgan, Bank of America, Wells Fargo, Citi, Goldman Sachs, like, and then the member banks for the Federal Reserve System, like, dude, they can't go under. They're the table legs for the B system. And when these other banks mess up, they just go, oh, distressed capital, that's what my degree's in. And they go in and buy them for fire sale prices. And I know that's super frustrating. You're like, well, we need to dismantle they. But you need, in my opinion, to just learn how to operate in this reality and have a framework that, you know, is kind of accurate and kind of, you know, it's reflective of what's going on and what's ultimately going to happen, you know. So if you're one of those people that's like, well, the rich get richer and that's like, this whole thing has to collapse. It's like, dude, yeah, the rich do get richer. But if you rail against reality, like, good luck with that. You're just going to end up getting railroaded and being really frustrated about it and being like a real hater. So, you know, at a certain point, you just got to say, this is the environment that I'm in. This is the framework. And I got to do the best I can with what I got. You know, it's a little bit fatalist, but it's also kind of red pilled. Like, there it is. There's who they are, you know. So we can talk about that. Like, clearly on the news, they're, not going to talk about BlackRock and Vanguard owning everything you see around you right now. So pretty crazy. That's who they are. And then we got the AI narrative continue to drone along in the background, right? So I've been messing with Chat GPT. What's pretty crazy is all these students are now having Chat GPT write their papers. And now the teachers are saying, well, if the students are writing the papers, I'm going to have Chat GPT grade the papers. There was a worker at Tesla that had like a bunch of things he was supposed to get done and report to Elon that he had completed. And he had done nothing on his list of things to do. So he asked ChatGPT, if I had gotten busy this week and gotten things done, what would I have done? And ChatGPT spelled it out for him. And then he said, can you write the code for that? And ChatGPT wrote the code. So, it's not just hype. It is pretty crazy. I would invite you to look into how disruptive some of this AI's narrative's going to be over the next 2 to 10 years, and then look for industries that AI is going to intersect well with, right? So like healthcare and education, So there's going to be just certain areas that AI truly excels at over the next few years, and it's going to really disrupt a lot of markets. So, the AI narrative is alive and well, but then again, the metaverse was this time last year, and, so innovation it's rough, but I do like tech, okay? I do like tech. So the AI narrative, I would expect to continue to kind of mull along. It's just picking the winners and losers that's going to be really difficult, and I wish you the best with that, but I do recommend you get hip to what's going on in AI. We're going to see a lot of interesting developments out of there. And then we have, you can talk about crypto. Crypto's doing pretty well. Bitcoin's like holding on to 28,000. You know what Bitcoin does to people? The Bitcoin market does as much damage to as many traders as it can at once all the time. That's Bitcoin doing its job. So these people that didn't want to buy at 17 because they were waiting for 12, they kind of got screwed. And then the people who did buy at 17 but sold at 25, thanks for your sacrifice, So up is down and down is up when it comes to that stuff, but I would buy the dips on Bitcoin. I would buy the dips on some of your favorite altcoins, especially if risk begins to drop in the overall market. I think if NASDAQ tech stocks start to do well, altcoins should really wake up and smell the coffee. And then, if gold dips a lot and people stop talking about it, absolutely. But at the very least, I would wait for dips in gold, dips in Bitcoin, I'm all about that. Dips in altcoins, some of these altcoins right now, quite cheap, about that life. Tech stocks, about that life. Oil stocks, about that life. Guys, I think it's the time to max out on growth, go out onto the end of the risk curve. And what we need to see now is wages catch up and growth catch up to inflation. But the inflation, it's not going anywhere, okay? So if you're still one of those people that's like waiting for consumer prices to like go back to normal, or you're saying things are really out of whack, when is it gonna go back? My policy prescription to that dilemma is get a pay raise, okay, and get your inflation basket down, like cut out any needless subscriptions or extra vehicles or whatever, like, kind of consolidate, get a little bit lower, get your CPI, your own personal CPI, your own personal inflation gauge lower, get your wage up. And yeah, we just need to get going again. I think the last 3 years has been very challenging, and we're still in a recession, okay? Like, if you're one of those people that's like waiting for the recession, it's like, dude, the last 3 years have not been fun. So if you're waiting for that recession, you're standing in it. And, when you're in a recession, book says buy, and in a 1987 flash crash type scenario like we saw last week, the book says buy. And when you're 20% off recent highs and you're all three major stock indices like we were, third quarter of last year, book says buy, all right? We have embedded growth obligations are in our institution, so embedded growth obligations. The beast system, they need the equity markets to do, I believe, 6 to 12% per year, 8 out of 10 years, regardless of any other metrics. If you're not getting the growth or you're having too much inflation, just to heck with that. They need to hit their benchmarks to keep the Ponzi, the system solvent, the social securities, the 401ks. We need to keep the system solvent. And if it's a debt-based monetary system, then I anticipate we print more and more in perpetuity just to remain where we are, never mind additional growth and productivity. So looking quite inflationary. One more thing and then I'll let you go. That Fed balance sheet, it's going up a lot, okay? So all the tightening we've done, all the QT we've done so far in 2023 has now been erased. So the Fed's adding aggressively to its balance sheet despite what you're hearing. They're going to keep the system backstopped. They're going to keep it liquefied and solvent, and they're going to destroy taxpayers and create a lot of inflation in the process. That's the part they don't want to talk about. Powell did deliver on his 25 basis point rate hike. Market was expecting it. I was expecting it. Said that there were going to be no interest rate cuts for 2023. So the market's really, that's why they sold off as soon as the Fed announcement was over. He said, I see no interest rate cuts in 2023 in the market. Did not want to hear that because it's already anticipating interest rate cuts as early as July. So, we've been seeing that theme for about a year and a half where the Fed insists that rates are going higher and going to fight inflation more aggressively. And then we kind of just see risk assets like somewhat deflate, a little bit of uncertainty, and then ultimately end up calling the Fed's bluff. It's because interest rates aren't above the inflation rates. So you're still going to have inflation. The Fed balance sheet is now expanding, and capital reserve requirements for banks are still zero. So banks, they don't need to sit on this cash. They're just going to stay in, 100% invested until their bond portfolio blows up, like with SVB. So until we raise capital reserve requirements for banks, until we get the interest rate above the inflation rate, and until we get that Fed balance sheet down to like zero, we're going to be kind of stuck with this inflation. But we're going to be all right. We're going to keep going, stay positive. That's really all I got for you today. Like, subscribe, share, comment, whatever. You guys are awesome. I hope you got something out of this. Just my opinion. I'm just framing, what I see. Till next time.